Welcome back to XRP Unfiltered, everyone. Listen carefully, because what you're about to hear isn't hype. It's not speculation, nor is it coming from a YouTuber, influencer, or crypto trader. This information comes directly from Paul Atkins, the newly appointed head of the United States Securities and Exchange Commission. What he stated on national television should completely alter how you perceive crypto over the next couple of years. He was asked a straightforward question: are major banks and financial institutions moving toward tokenization? His response was clear, direct, and without hesitation or political spin. He confirmed that this is precisely the direction financial services are heading, not in a decade or some distant future, but potentially within just a few years. Let that idea sink in. The very person at the pinnacle of the U.S. regulatory system publicly acknowledged that tokenization is no longer theoretical or experimental. It is the inevitable path for the global financial system. That revelation alone should make you pause. For years, crypto investors have been advised to be patient. Adoption takes time, regulators need to catch up. Yet now, the regulator himself steps forward and declares that tokenization is arriving faster than most expect. This isn't retail investors speaking to themselves anymore. This is the system speaking to itself. And this is exactly why XRP plays a crucial role in this narrative. As tokenization becomes a reality on a large scale for bonds, treasuries, securities, cross-border settlements, and real-world assets, the question ceases to be if blockchain will be used. The question becomes which infrastructure will be trusted enough to handle it. Ripple didn't begin this journey last year, nor did it jump in during the meme coin craze. For over a decade, Ripple has been embedded within the financial system, partnering with banks, regulators, central banks, payment providers, and liquidity providers, quietly building foundational rails while others chase speculation. And now, the timing is shifting. For a long time, the SEC was not leading innovation, it was obstructing it. It stood in the way, freezing progress through fear rather than providing guidance. Now, that posture is evolving in real time. Atkins explicitly stated that the SEC is no longer trying to block innovation, but is embracing it to keep the United States competitive globally. This represents a complete regime change. The conversation is no longer about crypto merely surviving. It's about crypto becoming embedded within the core financial system. This is where many people misunderstand. They focus on today's price instead of tomorrow's structure. They remain trapped in the get-rich-quick mindset, ignoring what happens when entire market infrastructures migrate to blockchain rails. XRP isn't positioned as a meme or speculative asset, it is positioned as infrastructure. When Paul Atkins says mass tokenization could arrive within a few years, it implies that settlement systems, payment systems, asset tokenization platforms, and regulatory frameworks are already being coordinated behind closed doors. Governments don't announce plans before the groundwork is laid. They build first, then go public. Therefore, when the SEC head says what he said, it signals the internal machinery is already in motion. That is why this matters so much. It also explains why countries are now racing to establish regulatory clarity. The first to set the framework gains first access to capital. Liquidity does not wait, it flows where it is allowed to move freely and safely. Once liquidity starts moving, it doesn't ask permission from slower jurisdictions. Tokenization is not just a technological upgrade, it is a geopolitical weapon. This is precisely why Ripple's long-term strategy matters. Trust takes years to build, compliance takes years to engineer. Global payment systems don't migrate overnight, but once they do, there is no turning back. For those who have been in this space long enough, this moment feels different, not because of price charts or social media hype, but because those who once opposed this industry are now openly preparing it for integration. You're witnessing resistance transform into infrastructure. If you've been dismissed for years for believing blockchain would reshape finance, this is one of those rare moments where the system itself confirms what crypto-native users already understood. Whether the market reacts immediately or months from now doesn't alter the underlying direction. Tokenization is coming, institutions are preparing, regulatory postures are shifting, financial rails are being rewired. That is the reality today. Now let's address the part of this story most people completely misunderstand. The real way XRP is currently being accumulated. If you're staring at price charts wondering why institutional interest hasn't caused an explosion yet, the answer is simple: you're not watching the right battlefield. The majority of serious buying is not on public exchanges. It happens through over-the-counter (OTC) desks, where institutions accumulate massive XRP amounts quietly without affecting visible prices. This is how smart money enters, silently building positions rather than chasing green candles. This is where ETF numbers become critical. By November 2025, spot XRP ETFs held around $650 to $775 million in assets under management, AUM. Within days, over $100 million more flowed in, pushing total AUM near $850 million, with projections targeting $1 billion within weeks, not months. This speed isn't driven by retail. It comes from funds, trading desks, and structured products activating capital flows. Here's an even more crucial point. Public ETF data reflects only purchases made on exchanges. It doesn't capture private purchases through OTC pipelines, which are intentionally opaque and undisclosed. That's why prices can remain flat while supply is being absorbed behind the scenes. Multiple institutional analysts suggest hundreds of millions of XRP have been acquired via OTC since ETF momentum increased. Exact figures aren't publicly verifiable because these desks are designed to hide footprints. Yet here's what most miss: the amount of XRP available via OTC desks is finite. Credible estimates place total OTC XRP supply globally between 1.2 and 2 billion tokens across major desks. Once this liquidity is depleted, only two supply sources remain: Ripple's escrow and public exchanges. This is where market structure fundamentally shifts. As long as institutions source XRP off exchange or directly from Ripple without impacting public order books, price pressure remains subdued. But when OTC liquidity runs dry, and buyers must compete for tokens on open exchanges, price discovery will become volatile and intense. This isn't speculation, it's supply and demand mechanics. Now, add to this the ETF landscape. Major issuers like BlackRock, Franklin Templeton, and others are actively preparing or managing digital asset products. New S1 filings are emerging for multi-asset crypto ETFs, consistently including XRP, not just Bitcoin. A significant milestone was Canary Capital's filing for US-based spot crypto ETFs explicitly holding XRP as a direct asset, not synthetics. This matters deeply because direct hold ETFs require real custody of XRP on-chain. Simultaneously, wealth management platforms controlling trillions in client capital are opening access to crypto exposure. For instance, Bank of America's private banking division is preparing to offer Bitcoin ETF exposure to advisors managing over $2 trillion in assets starting in 2026. Crucially, Bitcoin is the gateway asset but never the final destination. Institutions start with the asset regulators are most comfortable with, then capital rotates outward. This has been the pattern in every market cycle. This time, regulatory frameworks are in place from the outset. Once advisors gain comfort recommending Bitcoin exposure, clients inevitably ask, what else is there? That's when XRP becomes part of the conversation, recognized as a utility-driven infrastructure asset, not a speculative meme. Meanwhile, exchange-held XRP supply, particularly on platforms like Coinbase, has declined over 40% recently. Such reductions do not occur during fear-driven sell-offs, but during accumulation phases. Tokens are moving into cold storage, custody platforms, and private settlement channels. While charts appear stagnant publicly, behind the scenes the supply plumbing is being drained. This is precisely how major repricing events start: quiet accumulation, shrinking public supply, progressing regulatory clarity, and institutional vehicles coming online. This phase is not the explosive breakout but the position-building stage. Those building positions aren't chasing headlines, they're preparing infrastructure exposure for when OTC liquidity runs out. Ripple escrow narrows, ETFs must source directly, and tokenized treasuries scale. That's when price stops being optional. Presently, the market's quiet because the game is being set. The pieces are already on the board. Now, let's widen the lens to something even bigger many are overlooking: the tokenization of real-world assets. This is where the scale of what's coming shatters conventional price models. We're not just talking about crypto trading between speculators anymore. We're witnessing U.S. treasuries, bonds, private credit, commodities, settlement rails, and global liquidity infrastructure migrating onto blockchains. This isn't theory. It's already in motion. Tokenized treasuries alone are worth billions on-chain today, though that's tiny compared to the roughly $29 trillion traditional U.S. Treasury market. Institutions are live testing these systems with capital, and the largest financial entities are laying the legal and technical foundation to transition these markets onto distributed ledgers over the next few years. This is why Ripple's partnerships with real-world asset platforms are so significant. When treasuries, credit markets, and settlement systems go on-chain, liquidity moves differently. You can't move trillions on clunky legacy rails anymore. You need fast, neutral, liquid digital settlement assets. This is the crucial point most retail traders miss. On-chain treasuries mean no slow overnight batch settlement. Instead, liquidity moves near instantly between banks, funds, and counterparties across borders. That demands assets designed for speed, neutrality, and deep liquidity, not speculative tokens. Tokenization is therefore not a mere narrative. It's a fundamental structural shift in capital movement. NASDAQ filings supporting tokenized securities trading, regulatory sandbox programs, and global compliance frameworks are converging for this transition window between now and the latter half of the decade. Once this door fully opens, demand for on-chain liquidity will be immediate and enormous. Concurrently, exchange balances are rapidly dropping. When XRP supply on major exchanges declines sharply, it signals absorption, not distribution. Coins are moving into custody, not being sold off. This is what accumulation looks like in genuine markets, boring on the surface, violent later. Most expect parabolic moves to start with fireworks. Instead, they usually begin with months of silent supply removal. While retail sentiment remains confused and impatient, losses usually occur not from buying late but from exiting early when nothing seems to happen. Now, consider the psychological factor, perhaps the most dangerous for retail investors. Everyone craves instant gratification and rapid gains, but infrastructure cycles don't behave like that. Finance doesn't flip overnight because of exciting price candles. It shifts when laws, custody, settlement, and compliance align. This process is unfolding slowly right now. That's why those fixated on short-term charts often miss the most significant moves of their investing lifetime. When infrastructure locks in, repricing becomes violent and feels unfair to those lacking patience. This setup is risky in both directions. Over-leveraged traders risk getting crushed by fake moves, flushes, and volatility spikes during quiet phases. Under-positioned investors risk chasing prices when breakouts occur. The market emotionally squeezes both sides, telling impatient traders nothing is happening while quietly preparing institutions. Generational rotations begin not with headlines but through infrastructure, custody, compliance, and silent accumulation. Here's where the game changes fundamentally. What happens when institutional demand must hit the open market instead of being absorbed privately? One key pressure valve muting XRP's price has been off-exchange supply sourcing. Big money avoids public order books to protect entry prices, buying quietly OTC and through direct negotiation. But that works only while OTC supply exists at scale. Data suggests OTC supply is rapidly diminishing, forcing demand to flow through public exchanges. That's when repricing spikes sharply. Retail often misunderstands this, thinking price rises from hype. No, price goes parabolic when supply disappears just as demand surges. This isn't emotion, it's market mechanics. Currently, 3 pressure points converge: shrinking exchange balances, growing institutional ETF demand, and global tokenization infrastructure ramping up. This classic supply shock setup will trigger volatility explosions when large buyers compete for liquidity alongside retail traders. That's when multi-week vertical price moves occur, erasing skepticism overnight. Most will be unprepared, underallocated because they misread the quiet phase or over-leveraged attempting to time the move. Both suffer losses. Markets don't reward certainty, they reward correct positioning. Winners aren't the loudest on social media, but those who bought when nothing happened and held through months of silence. Institutions favor this phase because it allows large accumulation without competition or media noise. They build custody, compliance, and regulatory frameworks ahead of price discovery. By the time retail notices multiple green candles and assumes the breakout has begun, the real positioning is complete. Retail catches the middle of the move, never the base. So, if you wonder why prices feel stagnant despite bullish infrastructure news, that confusion is exactly the point of accumulation phases. If prices were soaring, institutions wouldn't be finalizing their setups. The market remains deliberately quiet. The silence is purposeful, and the longer it lasts with fundamentals building underneath, the more explosive the eventual move. Now, to ground this in reality, this is the stage where investors either protect themselves or sabotage their positions. Everything discussed here points to one truth: the opportunity is real, but volatility will be brutal. Tokenization, institutional ETFs, shrinking exchange supply, regulatory momentum, all create upside potential, but none guarantee smooth price action. Markets never move in straight lines, especially with leverage, derivatives, and global liquidity cycles involved. The same forces that propel prices upward can quickly reverse them in short time frames. This is not fear, but market structure. The next crypto phase will punish impatience more than any prior cycle. When liquidity turns on, prices move fast. But when liquidity retreats, weak positions are exposed instantly. Over-leverage, poor risk management, emotional trades, and chasing rallies late are behaviors that destroy portfolios before major trends mature. The market doesn't care about your bullishness, it cares about your positioning when volatility arrives. Survivors won't be those shouting weekly targets, but those preserving capital long enough to benefit when the big moves materialize. Institutions think in quarters and years, not minutes or hours. They size positions properly, hedge risk, and manage downside first. If you don't adopt that mindset, you're not competing on the same level, you're merely reacting. Here's a hard truth few want to face: even the best long-term outlook won't save you from poor short-term execution. You can be right on macro, but wiped out on timing. That's why preparation must precede excitement, and slowing down is more vital than speeding up. Understanding structure beats believing narratives. As this space evolves with tokenized assets, institutional rails, regulated custody, and new financial products, the opportunity set expands, but so does complexity. This market is no longer a simple speculation playground. It is becoming part of the global financial system, and systems don't move smoothly, they reprice through stress. If there's one takeaway today, it's this: stay informed, stay adaptable, and stay disciplined. Don't anchor emotionally to any single outcome. Let data, structure, and risk management guide you. That's how you survive long enough to capitalize when bigger moves finally unfold. Thanks for watching Journey to XRP. If this breakdown helped clarify what's really happening beneath the surface, share your thoughts in the comments. I read them all. And remember, this content is for educational purposes only and is not financial advice.